Okay, let's be real for a sec. Retirement planning can feel like a total headache, right? You're
Yeah.
trying to find that balance. You want your money to grow, but you also don't want to freak out every time the market dips, even a little.
Oh, absolutely. I mean, finding that sweet spot between growth and security, that's the holy grail for a lot of folks, especially as they get closer to retirement.
Totally. And that's exactly why we're diving into this today. We're going to break down a specific type of annuity, this F&G Flex Accumulator.
Interesting. Sounds pretty timely given all the market volatility we've been seeing.
It really is.
Yeah.
We're pulling our insights from Diversified Insurance Brokers. They've got some interesting marketing material about this annuity, and we're going to really try to unpack it, see if it lives up to the hype.
Love it. Always good to get a skeptical eye on these things. So before we get into the specifics, maybe we should take a step back. For folks who aren't familiar with this world, could you give us like a quick explainer on fixed indexed annuities? What are we even talking about here?
Yeah, that's a great point.
Yeah.
Not everyone's a financial expert.
Right, exactly. So an FIA, it's kind of like a hybrid. It combines the stability of a traditional fixed annuity with the potential for growth that you see in the stock market.
Okay, so it's not like putting all your eggs in one basket.
Yeah.
You're not going all in on the stock market, but you're not totally ignoring it either.
You got it. With an FIA, your money isn't directly invested in the market itself. Instead, your returns are linked to the performance of a specific index, like the S&P 500, for example.
So if the S&P goes up, your annuity value goes up too.
Generally, yes, but there's usually a cap on how much you can earn. And on the flip side, if the market tanks, you're protected. You don't lose your initial investment.
Oh, that's a big relief. I mean, that's got to be super attractive for people who are risk averse, especially if they're getting close to retirement and they can't afford to gamble with their savings.
Yeah, I'd say that's a major selling point for FIAs. Peace of mind. Knowing your principal is safe, no matter what the market throws at you.
Okay, so that's FIAs in a nutshell. But what about this F&G Flex Accumulator? I mean, the name itself kind of hints at some key features. Flex and Accumulator. What are we talking about here?
Right. It's like they're trying to tell us something with that name. So let's start with the flex part. One of the cool things about this particular annuity is that it gives you options. You're not stuck with just one index. You can actually choose from several different ones.
Oh, that's interesting. So you can tailor it a bit more to your individual risk tolerance.
Exactly. They've got the S&P 500, of course. That's your classic broad market index. But they also have things like the BlackRock Market Advantage Index, the Barclays Trailblazer Sectors 5, and even a Balanced Asset 10, which includes bonds for a more conservative approach.
So someone who's feeling a little bit bolder, maybe they're younger and they have a longer time horizon, they could potentially go for one of those more specialized indices.
Yeah, they could bet on a specific sector hoping to hit it big. But someone who's closer to retirement and wants to play it safer, they might stick with the balanced asset option or even the S&P.
So that's the flexibility part.
Got it.
Got it. But what about accumulator? How does that factor in?
That's where the real magic happens. See, at the end of each crediting period, any gains you've made are locked in. They become part of your principal. So even if the market takes a downturn later on, you never lose those gains. They're yours to keep.
Whoa, so it's not just about potential growth. It's about making sure those gains stick around.
Exactly. It's like building a wall brick by brick. Every time you make a gain, you're adding another layer of security.
That's a powerful image. I can see why that would be so appealing to people who are maybe a little bit nervous about market fluctuations.
It takes some of the stress out of investing for sure. You're not going to wake up one morning and see your retirement savings have vanished.
Okay, but let's be practical for a minute. Life throws us curveballs sometimes. What if you need to access your money before the contract ends? Let's say a big unexpected expense pops up, like a medical emergency or you need a new roof.
Right. Well, generally speaking, you have some limited liquidity. You can typically withdraw up to 10% of your account value each year without penalty.
10%. Okay. Not a ton of wiggle room?
It's not a free-for-all. But they do have some built-in exceptions, for certain hardships, like if you end up in a nursing home or if you get a terminal illness diagnosis, they'll let you withdraw more without penalty.
Okay, that's good to know. They're at least thinking about those what-if scenarios.
Right, they're trying to be realistic.
Yeah.
But you also have to be aware of the potential downsides. I mean, if you need to withdraw more than that 10% per year, you could be hit with surrender charges.
Surrender charges. Right, so it's not just a matter of taking your money out whenever you want. There are consequences.
Exactly. And there's also the issue of market value adjustments. So the amount you get back could be higher or lower than your actual account value, depending on how the market is doing at the time.
So there's a lot to consider. It's not as simple as just putting your money in and forgetting about it.
Definitely not. Annuities can be complex. There's no getting around that. But they can also be very beneficial if they're used correctly.
All right, so we've talked about the flexibility, the accumulation aspect, the liquidity.
Yeah.
What about the death benefit? The material mentions an enhanced death benefit.
Yeah, this is a big one for folks who are thinking about leaving a legacy. They want to make sure their loved ones are taken care of.
So how does it work exactly?
Basically, it amplifies any gains you've made over the life of the annuity. It's like a multiplier effect. So if you're under 70, they double the earned interest. And if you're 70 or older, they increase it by 150%.
So your beneficiaries get a much bigger payout than they would with a regular death benefit.
Right. Your initial investment is protected, of course, but on top of that, they get all those boosted gains.
That's pretty powerful. I mean, it could really make a difference for your family down the line.
Absolutely. It's a way to leave a lasting impact, to ensure their financial security even after you're gone.
Okay, so let's fast forward a bit. What happens when the contract term ends? What are your options at that point?
Well, you've got a few choices. You can renew the contract if you want to keep things rolling. You can convert the accumulated value into a stream of income payments, like a pension, which is a popular choice for retirees.
Right. Makes sense. You need that steady income coming in.
Exactly. Or you can just cash out and take the lump sum.
Right.
But if you don't actively choose one of those options, the contract will usually renew automatically.
So it's not like you're suddenly left high and dry when the term ends.
Not at all. There's a lot of flexibility built in. You can choose the path that makes the most sense for you at that time.
Makes sense. So before we wrap up, I think we should touch on the company behind this Annuity, Fidelity, and Guaranty Life. How solid are they? What's their reputation?
Oh, they've got a pretty good track record. They're known for being financially strong, and they have a disciplined approach to investing, which is exactly what you want to see in an annuity provider.
So you'd say investors can feel confident about their money being in good hands.
Yeah, I'd say so. They've been around for a while, and they have a solid reputation in the industry.
Good to know. Okay, so we've covered a lot of ground here. It seems like this F&G Flex Accumulator offers a pretty compelling mix. Growth, potential, downside protection, flexibility. But like we said before, annuities can be complicated. There's a lot of fine print to consider.
Right. It's not a one-size-fits-all solution. It really depends on your individual circumstances, your risk tolerance, your financial goals, what you're trying to achieve.
Absolutely. So for our listeners out there, the big question is, does the security of knowing your principal is protected outweigh the possibility of maybe missing out on bigger gains in the stock market? That's the trade-off you have to think about.
Yeah, that's the heart of it. You're giving up some potential upside for the peace of mind that comes with knowing your money is safe. And also, you have to think about those different index choices. How much risk are you willing to take on?
Wow.
Which index aligns best with your investment outlook? These are all important questions to ask yourself.
Great points. So this is just our take based on what we've read in the material. But like you said before, annuities are complex. It's always a good idea to talk to a qualified financial advisor before making any decisions.
Couldn't agree more. They can help you figure out if an annuity is right for you, and if so, which one makes the most sense for your specific situation.
Sound advice. All right, well, that's our deep dive into the F&G Flex Accumulator. Hopefully this has given you some food for thought and, helped you understand this annuity a little bit better.
My pleasure. Always happy to geek out about finance.
Thanks for joining us. And for all you listeners out there, keep exploring, keep learning, and until next time, stay informed.